Hey, did you know that commercial mortgages on investment property have prepayment penalties that are highly negotiable? I'm going to give you some tips here, what we learned over almost 2 decades of investing in commercial real estate and taking out loans from all types of different lenders, from community banks to CMBS lenders, life insurance companies, and people in between. So we're going to go through 4 different types of prepayment penalties. I'm going to tell you how they work and how you can negotiate some of those for your deal. First, let's talk about the simplest one. This would be a set prepayment penalty. So if you take out a commercial mortgage on an investment property, oftentimes the lender's going to want to make sure that their loan is outstanding for a certain amount of time so they make a return on their money. You can kind of empathize with the lender, because if they gave you a loan and they went through underwriting and they went to loan committee and they documented everything, and yes, they got a couple of fees up front, but they really didn't make interest that first month, or very much interest the first month. They want to make interest over a period of years normally. And so when you pay the mortgage off early because you sell the property or you refinance it, they're really trying to make sure that they're just protecting a certain return on their capital for their stakeholders. So the first type, that's the probably preferred way that we'll see prepayment penalties, is a fixed prepayment. This can be something like 1% or 2% of the loan principal will be charged to you as a prepayment penalty if you pay off the loan before it matures. And in commercial real estate, oftentimes mortgages mature or balloon in 5 years or 7 years, occasionally 10 years. They're not like residential mortgages that are 30 years long. So that prepayment penalty of a fixed amount, it's really helpful because you can always calculate if you're going to sell a property or refinance it, and you know that there's a fixed prepayment penalty with your current lender, you can calculate your return on your investment and know that it's exactly 1% of the principal and there's no ambiguity. That's the best type. Most lenders don't offer that, particularly in larger loans, and I'll tell you why as we go through the video. The second type that we see oftentimes from commercial lenders for prepayment penalties is a step down. The step down is let's say you have a 5-year mortgage, and the first year they say, look, if you pay us off in the first year, you've got to pay 5% of the outstanding principal as a prepayment penalty. The next year, if you pay us off, because the loan doesn't mature for 5 years, but you pay us off in the second year, it's stepped down from 5% to 4% of the outstanding mortgage balance. And the third year might be 3%, the fourth year 2%, and the final year 1% of the outstanding mortgage balance would be the prepayment penalty amount. So it's also really good because you know exactly what it will be, whether you want to refinance the property, sell the property, pay off the mortgage, etc. You've got really clear math to figure out in this second scenario of a step down prepay what you're going to do. And I've seen it like the example I gave where it's 5%, 4%, 3%, 2%, 1%. We've seen it where it's 3%, 3% the second year, 3% the third year, then 2% the fourth year, 2% the fifth year, 1% the sixth year. Like, it can be whatever you negotiate with the lender. We've also seen it where it's 5, 3, 1 different years of different prepayment penalties. Just realize the longer your loan's outstanding, the lower the lender is going to be willing to go as a percentage as a prepayment penalty of the balance that you borrowed. So that step down prepay is pretty helpful if you know those are moving terms. The third scenario that lenders use for prepayment penalties is yield maintenance. Oftentimes you see more sophisticated lenders like life insurance companies will use yield maintenance. And what they're trying to do is the lender's trying to maintain the yield, or as an investor we think of it as internal rate of return, on their capital that they deploy. So if they deploy capital and they're trying to make a 9% per year yield on their capital and you pay them off early, they're not really going to get there if they have a 7% coupon or a 7% interest rate. So what they do is they have yield maintenance that charges you an amount of money to pay off the loan early so that they maintain the yield they were trying to get by using this capital as a loan for you. So when you have yield maintenance, the challenge is you don't exactly know what the amount will be because it depends when during the mortgage you pay it off. But what you can actually do is say to the lender, like, look, what are you trying to get as your yield? It's not just their coupon, because they've got fees up front. That goes into their total return. Think about an IRR for us as real estate investors. When a lender lends you money, they make fees up front, they make an interest rate or coupon during the loan, and then they have the back end exit fees or prepayment penalties. They take all that into consideration, and they just really do an internal rate of return calculation. And when they want to make sure they get whole on what they've told the loan committee that they're trying to do with your loan, that's the way that they protect it, is yield maintenance. And so that's a really interesting way to think about how the lender wants to make themselves whole when you're paying them off early and you have a prepayment penalty that's using yield maintenance as the mechanism. So harder to calculate, but really understandable when you think about it as IRR from the sponsor or real estate fund side. Hey, sorry to interrupt. I just wanted to let you know we drop new content all the time. So go ahead and hit subscribe. You'll be first to be notified we've got something new that comes out. Whether you're interested in our real estate investment tips or business ideas like AI. Now, back to the video. The fourth category is maybe the more complicated and trickiest one to understand, which is called defeasance. Defeasance really comes out of the capital markets world, and it's really kind of comparing bonds or fixed incomes. And so what happens when you get like a CMBS loan, there's other categories that fit into using defeasance, but this is the most well known. So if you get a CMBS loan, commercial mortgage-backed security, it's great for several reasons. Typically non-recourse, sometimes they have interest-only periods, sometimes they can go longer duration than other lenders, but the challenge is they sell these loans, as the name implies, as commercial mortgage-backed securities. So they sell them as fixed income bonds to investors through Wall Street in the capital markets. So when people buy these bonds, whether you're an insurance company, a pension fund, an endowment, a sovereign wealth fund, you buy these, you're trying to get a certain return for that use of capital. So just think about some investor can allocate to anything, and they say, look, we want to allocate some of our money to commercial mortgages, and so we know we need to get a set 6% return. Well, that happens by them buying these commercial mortgage-backed securities that are the mortgage on your property. Now, fast forward during the loan, let's say it's a 10-year duration CMBS loan that you took out on your investment property, and it's got a 6% coupon or 6% interest rate. If bonds, everything from US Treasuries to corporate bonds, change in interest rates, that means that that capital allocator that invested in the commercial mortgage-backed security that's on your property, if they got their money back, they would go have to invest it somewhere else to get the same return. Here's the weird thing. When you've got defeasance as your prepayment penalty, and let's say you're paying this 6% mortgage rate, and interest rates go down, and you want to pay it off, the person that invested the money in the commercial mortgage-backed security has to go reinvest that money in the market. But if interest rates were at 6% on your loan and they thought they had that for 10 years, now the market 5 years later goes down and it happens that interest rates are at 4%, defeasance basically says, how can the investor make up the money for the rest of the loan period so that they would have really made 6% the whole time? So here's the weird part. If interest rates go down to 4% and you want to pay off the mortgage, you've got to write a check because that money is going to go invest in bonds at 4%. That difference of 2%, you have to make up as a prepayment penalty for the people that originally brought the capital to your CMBS loan. So what's weird is interest rates for you might have gotten better as a real estate investor, but for the capital investor that provides mortgage money, they got worse. So lowering interest rate environments when you go to do a payoff and you have defeasance can be really problematic. In one portfolio that we sold several years ago, we ended up paying $7 million in prepayment penalties to sell a portfolio. Clearly, because I'm saying past tense, we did sell the portfolio. the profit for our investors was so large that it made sense to pay $7 million in prepayment penalties. But I guarantee you one thing, we'll never do that again the same way, because we learned how yield maintenance is calculated, how defeasance is calculated. When we take out a loan, we want to negotiate, can we get a step down prepay instead of defeasance? And so knowing how these 4 types of typical prepayment penalties work for you as the borrower are really empowering for you to get the best deal. You always want to think about a loan as if you are going to pay it off early and what the implications will be. Even though you might take it out thinking this is a 10-year loan, we're going to hold the property for 10 years and then sell it, and that's the investment plan with our investors. You want to know if the market becomes in your favor from a value perspective and you sell the property early, are you going to incur millions of dollars of prepayment penalties, or can you exit it because you were smart enough and proactive enough to negotiate a fixed or step down prepayment penalty, and you're not subject to capital markets like defeasance or even a lender's yield maintenance calculations. And so knowing how these work are really empowering. By the way, one last tidbit, I get people ask me all the time, hey, if I negotiate a CMBS loan that has defeasance, and let's just say, for an example, I've got a 6% rate, and interest rates go much higher, and they go 8%, and I pay the lender off, do I get paid back? Because now they can take their 6% that they were getting to lend me the money and go reinvest it in bonds at 8%. And you would think logically the answer would be yes. The investor would be happy you paid off 6% loan so that they can go reinvest in bonds at 8%. The reality is it almost never happens, because in the loan docs it'll say that if it works against you as the borrower, you pay the money because interest rates went lower than you originally borrowed at from that lender. But if it goes the other way and bonds are higher, that you don't get a check from the lender. So be careful. That's not a benefit for you and a downside the other way. It can actually be just neutral or negative. And so whether you're doing, fixed prepayment, step down prepay, yield maintenance, or defeasance, you really want to do scenario planning. A whole bunch of what ifs. What if we paid off the mortgage here? What if interest rates go up? What if interest rates go down? What if we pay off the mortgage later? So having all those scenarios when you're underwriting your loan options up front will really help you protect your investors' return on their investment, whether it's IRR, cash on cash, or eventual multiple on invested capital. You understanding how loans work when you pay them off is really critical. Hope this helps. Please share it with a friend, and we'll be back for more episodes later.